Have you ever found yourself staring at your trading account, wondering where it all went wrong? Well, you're not alone. Most traders fail because they don't know how to manage risk. And so in this video, I'm going to reveal essential risk management tips so you can finally end the cycle of blown accounts, sleepless nights, and endless frustration. I'm Karen, and I've literally spent over a decade trading. And after years of mistakes, lessons, I've built golden risk management rules, which have helped countless traders worldwide, just like you, to turn their trading around. So imagine this. The price of the instrument you are trading goes up. You short, then get stopped out. The price goes further. You short yet again. And once again, you get stopped out. And now you're frustrated. You revenge trade and completely wipe out your account. So why did this happen? Is it really because you lacked discipline? Or is it because you lack the tools to protect yourself from losses and emotions? So really protecting you from you. And just before I reveal the golden risk management rules, why is risk management even important? Well, without managing risk, you could have the best strategy in the world, but you won't have enough shots left for your strategy to play out. Say you lose 5% of your trading account. It doesn't take you 5% to actually recover it to the starting balance. It actually takes 5.2%. Similarly, if you lost 10% of your trading account, it doesn't take 10% to regain the starting balance. It actually takes over 11%. So as you have more drawdown or losses in your trading account, not only does it take a greater percentage gain to get back to the starting balance, it also affects your psychology as well. Because the question is, after such losses, will you still trade the same way? So the first golden risk management rule is, if you have 3 consecutive losses, just stop trading. And this is to prevent revenge trading. Back-to-back losses can definitely affect your psychology. And we're only human after all. Perhaps you had a bad day at work or had relationship issues. And subconsciously, these factors can influence your trading. And it's really putting a hard stop on you. So you stop trading and start fresh the next day. Because otherwise you can completely wipe out your account. And this single rule has helped various clients that have come to me for help. The next golden rule is limit your daily losses to max 3% of your account per day. So in other words, assuming you're risking 1% of your account per trade, if you lose 3% of your account, just stop trading. And remember, the whole point of trading is capital preservation. We're trying to get steady, consistent returns whilst preserving our existing capital. And so trading is different to investing, which is more about long-term wealth. And so investing can be more susceptible to fluctuations in your account. And the final golden risk management rule is don't exceed 10% total drawdown. So in other words, say your account balance is $100,000. If you lose more than 10% of that, so if you lose 10K out of that 100K, pretend that you've lost access to your account for good. And so all these rules really help foster discipline. And remember, no one's born with a discipline gene. It's not like as if you were born in your mother's womb with some kind of gene that said, okay, listen, this guy has discipline for the rest of his life. No. And these golden risk management rules will really foster discipline and protect your psychology. And it doesn't matter if your account size is 1,000, 10,000, 100,000 or 1 million and greater. In fact, I've helped traders with all account sizes. Your account size doesn't excuse you from risk management rules. Another question that I get asked all the time is, what percentage of my account should I be risking for trades? And I would say, you should be risking max 1% of your account per trade. This way, you have 100 attempts before you actually blow up your account. And getting that many losses consecutively would be pretty difficult. Now, if you felt really confident, sure, you could risk 1.5% of your account per trade. This way, you would have 66 attempts before you blow up your account. At the very most, you should be risking 2% of your account per trade. But in general, for most trades, I would recommend risking 1% of your account per trade. And if you're highly confident, maybe 1.5% of your account per trade. The general rule of thumb is if you're going to bed at night thinking about your trade, then you're probably risking too much. And that has always been my litmus test. I can't tell you the countless number of traders that have come to me for help and are risking large amounts of their account per trade. For example, if you're risking 10% of your account, that means you only have 10 attempts before you blow up your account. And so even with the best strategy, that might not be enough for your strategy to play out. Similarly, if you're risking 50% of your account per trade, you only have 2 shots left. And really speaking, you should just be in a casino in that situation. And even the best traders on Wall Street have a quarterly outlook on their trading performance. And so they have to really manage risk for their edge to play out. I also wanted to talk to you about the dynamic nature of risk management, because this is something that confuses people. Say, for example, Bob risks 1% of his 100K account. So he risks $1,000 on a Bitcoin trade. If he wins that trade, and assuming he goes for a 1-to-3 risk-reward ratio, then he would gain 3% on his account. So he would make $3,000, meaning that his new balance is 103K. Now, if he took a new trade on that 103K account, he would still be risking 1%, but the dollar value risk would be $1,030. So as your account size increases in dollar value, the dollar risk increases, but the percentage risk is still constant. Similarly, say Bob started with a 100K account and risked 1% of that account, so $1,000, but then lost that trade, he would now have 99K. Now, if he was to take subsequent trades, his risk per trade would be $990, but he would still be risking 1% of his account. So as you lose money in your trading account, the risk percentage is still constant, but the dollar value decreases proportionally. And so this is how I would recommend dynamically managing your risk. And this is, again, to protect your psychology and drawdown as well. So say Bob takes more trades, but then by the end of his month, he grows the account by 10%. He would now have 110K. Now, if he was to take subsequent trades, he would still be risking 1% of his account, but the new loss per trade would now be $1,100. And this again shows you, as you grow your account, you can actually risk more in dollar value, but keep the percentage risk still the same. And this can really lead to exponential growth in your trading account. So the way you actually grow your trading account isn't by betting the farm on one single trade. It's actually by protecting the downside and sensibly managing risk, so your strategy plays out, and so you actually live to fight another day. And applying all of these risk management principles in this video will really help to take your trading to the next level. And if you want to avoid costly trading mistakes, then you can't afford to skip my previous video.